This is lecture 7 in the series on banking and finance, the sort of lectures that will be given to undergraduates just starting a degree in this subject and indeed thinking of a career in banking and finance. This is all about derivatives. Now, derivatives are very difficult to understand if you look at the situation as it is now. In fact, so difficult to understand that I will explain in a following lecture that derivatives and derivatives markets were the actual cause of the global financial crisis, because people inside the derivatives markets don't know what's going on. The central banks and the governments don't know what's going on, therefore they couldn't regulate them correctly, therefore they got away with lots of silly things that eventually unfolded into the global financial crisis. But as with all things, if you sort of go back to the beginning and try and understand how derivatives first developed, then you will be able to understand where we have got to today. Derivatives have value, but they're called derivatives because they derive that value from some underlying asset. Technically, they don't have any value themselves in isolation, but they derive value from something else. Often it is a contract about something that will be delivered at a certain price in the future. The lecture that I used to give on this particular topic was called Derivatives, the Good, the Bad and the Ugly, because there's a good side to derivatives, that is, they provide a positive service within the business sector. There's a not quite so good side when you move out of sort of sound business management into speculation. And speculation has its even worse side when you go into gambling. And you'll know that there's big demand for gambling. You look at all the gambling sites that there are online, advertised at sports venues and so on. So unfortunately, the sort of gambling bug has slipped over into the financial services sector, and it is one of the issues that really needs to be addressed and dealt with, because gambling is a problem. Gambling is a problem for individuals who get carried away with gambling using their own money. I would advise advise any of my undergraduates ever to get involved in gambling, remembering that gambling really is uninformed decision making. I would argue they need to be very careful with speculation, because speculation, although it's informed, is again a risky area to be in, and one must always assess the risks. But gambling, I suppose you can gamble once. I'll let you gamble once, but never gamble again. I gambled once just by chance at the Labour Club in Dartford. My father was a staunch supporter of the Labour Party, and he used to take me down to the Labour Club in Dartford to play snooker. And in there, when I went down there first time, I think when I was 14, they had a one-arm bandit, which you can't get more into gambling than a one-arm bandit. I had one coin, I put the coin in and I won. I've never ever gambled again. I used that money to take a girlfriend out that particular evening, and that girlfriend became my wife, and in fact, strangely enough, it's our anniversary today, so I thought I would treat her by doing a lecture that she could listen to later on today. And I would say, therefore, gamble once. If you win, never gamble again, and you'll be, like me, one of the very few people who've made money out of gambling during your life. Or if you lose, as you probably will, learn the lesson and never gamble again. You'll become much richer if you never gamble. So gambling is a problem for individuals. Gambling becomes a bigger problem if you're using other people's money. And it becomes an even bigger problem if you find yourself in a situation where you can pass on the losses that you make in gambling to other people, and you can keep any profits you make for yourself. Gambling, it's a zero-sum game. It is not productive as an activity. It may be fun, but there's an equal number of winners and losers in any gambling scenario. So my advice to you is don't gamble. So we're going to look at derivatives from 2 points of view. We're going to look at derivatives from the point of view of how they developed and how they can be part of any business's sound management policies. And we'll also look at it from the point of view of speculation, which can be okay under certain circumstances, and gambling, which leads us into a lot of problems, as we will see. So let's go to derivatives and work out where they came from. There are financial derivatives, there are markets for exchange rates, there are markets for interest rates as derivative products. Of course, there are primary markets for exchange rates and interest rates, but also there are derived markets, the derivatives markets, which are based upon those areas. There are commodity derivatives. There are derivatives in crops and oil, gas, metals, etc. Why? The reason that derivatives develop is that business likes certainty rather than volatility, particularly in terms of volumes and in terms of prices. So businesses want certainty, and they even prefer certainty over missing out on a potential profit. And if what businesses want is certainty, then trade is enhanced if you have derivatives markets. Going right the way back, if we look, the early derivatives were commodity derivatives, and what they were was basically forward pricing. You know, the agricultural industry has a very variable output. It's dependent on, for crops particularly, on the weather, and the weather can be good, the weather can be bad, there can be problems with crops if there are things which damage crops. So farmers might end up producing a large surplus one year or a deficit, a much smaller total than they originally hoped to produce. And I would ask my students the question at this point: what do you think farmers would like? Do they like a year where if 100% was their crop total, they end up with 120%? Or if 100% was their total, then they end up with 80%? Which do you think farmers would prefer? And of course, everyone goes for, they'd like 120% rather than 100%, but of course they wouldn't. Because 120% forces the price down, and the price will and can go down below covering your costs. You can make losses. Whereas shortages, only producing 80%, if all farmers are producing much less, forces prices up, increases profit margins, and can be beneficial to farmers rather than the other way round. But this volatility that takes place from year to year, dependent upon something that is very difficult to control, means that farmers might be tempted to deal in a forward market, a forward derivative market. Now, what that means is a farmer who is planting his crop now to be hopefully reach maturity and be harvested in 6 months' time, would quite like to sell that crop now. Equally, someone buying that crop might be happier to buy at a fixed, secure price now. So what happened is farmers will negotiate buying contracts with buyers at the point in time that they sow their seed rather than when they reap their crop. So that creates then a forward contract. And those forward contracts would be negotiated often 6 months ahead. Now those forward contracts have value because you are buying a crop at this price in 6 months' time. So a derivatives market may develop around that, because it may well be that the price of the crop starts to rise well above the contracted fixed price, and other people might be therefore willing to buy into that market, and you may make a profit because you negotiated a fixed price that's now lower than the market price, and there's money to be made, if you like, in a secondary market, a derivatives market for those crop forwards. Now, can you lose out if you fix prices in the future? So go back to our crop. You've agreed to buy a certain quantity of a crop in 6 months' time. Price is fixed. There's certainty. You know exactly where you stand. Can you lose out? Of course you can, because in 6 months' time, it might have been that year when there was 120% harvest, prices fall, and you could have bought it a lot cheaper, but you have bought it at a fixed price. So the forward contract doesn't it supplies you with security and certainty, but it could be a lot more profitable not to have done it that way. It could have been profitable to wait and purchase the contract, purchase the crop at some point in the future when the crop is harvested. Financial derivatives, well, they've been around again for a long time, but they didn't really take off until after 1972. Now, what happened in 1972, you will say, and what happened was that we went off the fixed exchange rate system, which was called the gold exchange standard. And the gold exchange standard supported fixed exchange rates around the world, developed out of the meeting at Bretton Woods after the Second World War. And it was a bit like the gold standard, but only governments got gold for their money. No one else did, and everyone got it, of course, during the gold standard if they wanted to change their notes into gold, but now only governments get it. So what happened was the US fixed a dollar against gold. I can't really remember, to be honest, but I think it was an ounce of gold cost $32, and it was fixed at that price. And then all currencies were fixed against the dollar, and fixing them against the dollar meant that they were fixed against gold. And therefore, if a country on its balance of payments had an outflow of currency and not sufficient inflow of currency, so in other words, it ended up with a deficit on its main account on the balance of payments, it could settle that account, if you like, by transferring gold to another country. And that transfer of gold to another country would allow the other country to be reflationary, expand monetary demand, and the country that lost its gold would be deflationary and have a contraction in gold, which should create equilibrium on the balance of payments, because when you have a deflation in your economy because of the fact you're buying by value too many imports and not selling enough exports, then under those circumstances a deflation in demand will reduce the demand for imports, which is what you want to do, and it will actually encourage people who sell in domestic markets perhaps to look to foreign markets, which have now become more profitable. So yeah, the fixed exchange rate system worked and created stability. There were adjustments that took place where exchange rates became undervalued seriously or overvalued seriously. So there might be an agreement to revalue your currency against the dollar or devalue your currency against the dollar. But basically, you were in a period where businessmen knew what they were doing when they were trading. If you had a contract now to buy something in 3 months' time, you know that the price of the foreign product in the foreign currency will be exactly the same as it is now, because these currencies are fixed. As an economist, I suppose, let me explain to you what a fixed currency means. It isn't actually fixed. The currency is just determined by market forces. The reason that it's said to be fixed is that the government, usually through their central bank, will buy and sell in that market to maintain the fix. I can remember a fix of $2.40 against the pound, which allow fluctuations to $2.38 to $2.42, and as it was moving away from the fix at $2.40, so the bank would get involved in either buying the currency or selling the currency to bring its price back to $2.40. So that's what a fixed exchange rate means. It's a sort of floating exchange rate where the governments intervene in buying and selling the currency to maintain that fix. But it supports international trade because you know where you stand. Remember, I said earlier, businesses like certainty, and so the fixed exchange rate produced that certainty, and there weren't many important financial derivatives markets pre-1972. It all kicked off after 1972 when exchange rates were floated. America couldn't maintain it. It's had wars to finance Korea and Vietnam, and it couldn't maintain the value of the dollar against gold. So exchange rates were floated, and exchange rates were floated around the world, and currencies became much more volatile. Sterling particularly volatile in a downward direction, I think because of monetary mismanagement during the 1970s in the UK. Sterling fell by about 40% over a significantly short period of time in the 1970s. So now we have a situation where business is actually searching for more security, and it's not there. There's much more volatility in currencies, which means that trying to make agreements with other countries became particularly difficult. Now, as is often the case, when governments and central banks make a muddle of things, the market provides a solution. And indeed, the market provided a solution after 1972, in as much as the foreign exchange market separated into two little bits. It separated into a spot market and a forward market. The spot market you went into to buy your currency at today's prices. The forward market was the one that gave you security, because you could go into that market and you could buy the currency that you want at a fixed price now to be delivered to you in 1 month's time or 3 months' time or 6 months' time. I don't know, can't remember how far you could buy it forward, but let's not go any further than 6 months. And what you would do is you would just pay a premium over the current spot price to compensate for the person who's selling, make them a profit if the exchange rate moved in the right direction for them, but cover the potential for loss if the exchange rate moved in the wrong direction. Straight away then, you've got a forward market here for currency, which was developing because businesses want certainty. And the spot market didn't give them that. Prices were very volatile as exchange rates were floating. But now you could go into a market, and it was an over-the-counter market that is bespoke to whoever entered that market. They could buy any quantity of currency that they wanted and make a personal contract with the counterparty. This was the beginning, if you like, of a derivatives market for currencies, because again, if you buy currencies now for an agreed price in the future, those prices might become very attractive, and you might be holding on to a particular currency that now is worth a lot more than the market price, because its value has increased over the first few months of your 6-month contract, and you might look to go to a secondary market and take your profit, sell out. So derivatives markets started to grow around the forward market and currencies were traded. That increased so much that futures exchanges started to grow, where there were exchange traded quantities of currencies and other things as well, because the first big futures market in London was LIFI, or LIFI, the London International Financial Futures Exchange, which was set up in 1982, where you could speculate on future prices. Unfortunately, you could gamble as well on what might happen to the price of a currency, what might happen to the other commodities or financial derivatives that were sold through that market. So the market's beginning to create the certainty, the security that business wants by developing another market which then takes on the characteristics of this derivative market. This market in which you have got products which have value, but products that only have value derived from some underlying asset. Now, why get involved in derivatives markets then? Well, you can get involved in derivatives markets because you want to manage good sound practice or hedge risk in your business. You can also create positions for profitable speculation and arbitrage. Remember, speculation is making a gain after a passage of time. Arbitrage is actually identifying different prices in different derivatives markets in different parts of the world or different parts of the same country, where you could buy and sell immediately at the same point in time. So these markets were creating the opportunity to speculate and make money through arbitrage. Now let me remind you why they're called derivatives. They're derivatives because they only have value because there is an underlying asset that has value. And in fact, on the derivatives market, these these derivatives will only have value until a contract expires, when they no longer have value. And derivatives can be traded over the counter. They're bespoke deals, or they can be exchange traded. Exchange traded is usually for set quantities. So it might be you could buy 100 or 1,000 or 2,000, but you can't buy any number in between. Whereas over the counter, you can buy any number that you want because you're just making a bespoke deal between you and the seller or the buyer of the derivative. And derivatives are always cash settled before the expiry date or settled by physical delivery on the contract future date, or indeed there are certain products where they're both cash settled and physical delivery. That's where cash or foreign exchange is involved. So both of those things can occur. Now, there are an enormous quantity of derivatives, as you can imagine. If you were thinking of betting on a football game and look at all the ways that you could bet on a football game, I have no idea how many there are, other than there are lots of ways of betting on a football game or a sports game, because over time new ideas develop about this bet or that bet. And so it's happened in derivatives markets. There are more and more derivatives to look at, and all I'm going to do, because I'm only trying to introduce this to you and make it easy to understand rather than go straight into the complexity of all derivatives markets that are out there. And once you've grasped this, then hopefully you would be able to go out there and start to add on and understand the other derivatives that are out there and why they're out there. They're variants of the basic derivatives that we've been describing and will continue to describe. So I'm just going to talk to you about four derivatives markets: the forward market, the futures market, the swaps market, and the options, just to give you a flavour of what derivatives and derivatives markets mean. Forward contracts were actually what we described when we were looking at farmers making a contract in 6 months' time to sell their crop. And these forward contracts are often used with crops and with currencies. I mean, you can imagine them both occurring together, because if you're making a contract now to buy a crop in another country, you're going to fix the price in the other country, but you're going to have a risk involved in an exchange rate. So you may want to fix both risks by buying forward your currency as well as your product. Now, forward contracts, they are binding contracts. That's it. Once you've got the contract, you've shaken hands or you've signed your contract, then they're binding contracts. And they're all described as over-the-counter, OTC contracts, because they're personalised, they're bespoke. It's just you, the seller, and the buyer, or you, the buyer, and the seller. So these are nice, simple and easy contracts to understand, and they are contracts that we've already described. Swaps. These are a little more interesting. Sometimes mistakes are made in trying to understand these, so let's just go through the simple side of this. The simplest form of swap is what's called a plain vanilla swap, and it's an interest rate swap where you're going to swap fixed rates for variable rates. Now, the mistake made here is to think that the loan is what is swapped. It isn't the loan that's swapped, it's the way that you pay for that loan that's swapped. So, for example, you've got two people, they've both got loans that they're going to have for 5 years, and they borrowed £1 million. Let's make life nice and easy. One has agreed a 5-year fixed deal, is paying a fixed rate of interest over 5 years. The other one is accepting the market rate, so it's a variable rate of interest. Now, you don't swap the loans, so these two loans still sit with the same people who originally took them, but they might decide to swap the payments. It might be that you've got a variable rate for 5 years and you really want security and certainty, so you would like to have a rate fixed, and there's someone with a fixed rate will swap with you. Equally, the person with the variable rate might be thinking that they're paying what might be a relatively high rate in the future. They may have some feeling for the fact that rates are going to fall, and they may be quite happy to stay with variable rates and get rid of their fixed rate, so there can be a nice easy swap. So interest rates, the plain vanilla swap is just two contracts for loans, one with fixed interest, the other with variable interest, and they swap the stream of payments. They don't swap the loan, just the stream of payments. Now, of course, that could happen between people in different countries. So it could well be that an interest rate swap would also involve exchange rate risk. So you could be swapping interest payments, fixed and variable, between countries, and therefore increasing the risk involved of a change in the foreign exchange rate of the currencies that you are dealing with. So that's all swaps are. They swap streams of payments on loans, and they may be swaps that take place in the same country, in the same currency, or they could be between countries and involve different currencies as well. Futures are almost exactly the same as, I suppose I shouldn't say almost exactly, should I? Almost the same as forward contracts. So they're actually exchange traded forward contracts. So these are the sort of things that you would buy in prescribed quantities or sell through the London International Financial Futures Exchange, to mention one. In America, it could be commodities, and you could be dealing with the Chicago Mercantile Exchange. The quantities are standardized, so you could be dealing in financial futures, shares, bonds, currency. You could be dealing with commodities in these futures markets. And here, there's a commitment to complete. So once you've made this future deal on a forward contract, then you are committed to that, which means that this market has a sort of unlimited upside and downside in terms of risk and speculation, because you could make lots of money and it could continue to grow, or you could lose lots of money and you could continue down to lose all. And because of that, there's often a lot of hedging involved in these markets. That is, if you think you're in a situation where you've made a mistake and prices are going to go down, you make an equal and opposite position for yourself. If you've bought and you're holding, you now sell a contract, an equal and opposite position, which will hedge you against that loss into the future. It's a sort of what traders would know as a stop loss created on a price change. So futures markets are a little bit like forward markets. The forward markets were bespoke and personalized. The futures markets are just fixed quantities that you would buy and sell of all of the things that we have described so far in terms of commodities or in terms of financial derivatives. The last one that we could look at, just to illustrate this because it is quite interesting, is the options. There's a big options derivatives market where you can buy an option to buy something in the future. So when you buy an option, it means that you will agree in 1 month's time, 6 months' time, whatever, to buy a quantity of something at a fixed price. So you have bought that option and you become the option holder. It's an option call if you go for the official language, and you just buy the right to buy an item at a certain price on a specified date in the future. Now you've got to have someone to sell that to you. So there are option writers, where this is referred to as a put option. Think of it as option to put up something for sale. The option writer, or the put, sells you the future right, and you pay a premium for that. So if you don't exercise the option, I'll explain what that is in a moment. If you don't exercise the option, the person who wrote the option just takes the premium. And the option is one way only, in the sense of the holder can opt out. At any point in time, the option holder can give up their right to buy at a certain price in the future, and if they do that, they lose their premium. So let's put some numbers to this to try and make it clearer, because it does allow you to leverage your purchases. If I had £1,000 and I wanted to go out and buy some shares in a company, suppose the company was £1, make life nice and easy, I could go out and buy £1,000 speculating that their price is going to go up in the future. Or I could use that £1,000 to buy an option to buy, shall we say, 100,000 shares of this particular type. So I would pay my £1,000 over, and if these shares moved up in price over the specified period of time, I would make a lot more money having bought an option to buy 100,000 shares than if I just owned 1,000 shares. If things go wrong and I don't exercise my option, I just lose £1,000. So the person who writes the option gets £1,000, the person who holds the option can lose £1,000, but there's an upside to this where I could have made a lot of money if these 100,000 shares that I had an option on doubled, trebled, whatever, over the period of time that I was holding it. So you can see that these markets are quite attractive to speculators, to gamblers, unfortunately, because for a small amount of money you can just buy an option in something and you have a limited downside. You can only lose the premium that you pay to buy the option. And when options are in the money, that is, they're going to make money, then the secondary option market kicks in and other people may be interested in buying that from you, and you may be interested in securing that profit by selling them on the market. So the options markets are big, and they're big and interesting. Now, if you're interested in entering derivatives markets, then you will come across various descriptions of people as being risk averse, don't like taking risk, risk takers, exactly the opposite, do like taking risk, or risk neutral. Let me think of a way of just illustrating this to you in a way you'll understand. If, let us suppose, we're now coming up to Christmas and we can dream that you might be able to travel away in 6 months' time on a holiday. You decide that you want to go to the USA. Now, this is going to be a big holiday and you're going to need lots of dollars when you get to the USA, and you book your flight so you know you're going. What do you do about the dollars that you will need in 6 months' time? If you're risk averse, you will buy your dollars now and you will hold your dollars for 6 months. You might even better hold them in a way that you can make more money with them. But if you're risk averse, you buy the dollars now. If you're a risk taker, because remember, if you buy your dollars now, you could actually still lose, even though you've got a certain price. If you're a risk taker, you say, no, I'll wait until the day before I go to America, and I will buy my dollars then, whatever the price is, and I may make money compared with today's price, or I may lose money. I'm a risk taker. Or if you are risk neutral, which might be a sensible thing to do, you might transfer half of the money over into dollars now at today's price, and hold back on the other half and buy at the last minute before you go to the USA for your holiday. So the risk averse, the risk taker, the risk neutral person is someone that you will come across when you're in these markets, and those words will be described to you. Now you know what they mean. There is, unfortunately, a casino effect, if you like, something that I introduced in the previous lecture where we were talking about retail banks and whether they should be separated from other forms of banking, and I finally suggested to you that casino banking was not the way forward for conglomerates, that you should remove proprietary trading. But derivatives are a great area for, if you like, the casino effect, for people to get in there, buying forward, buying futures, buying options, closing out when they're in the money, borrowing lots of money. Options create that sort of leveraging effect where you can buy an option to buy a lot more shares than you can actually afford. And all of those things, if you just look at these markets, they've really expanded exponentially. There's an enormous amount of dealing taking place in derivatives markets. And there are also problems because the point about casino banking was, whose money am I using? If you're part of a big conglomerate, then I can risk money in proprietary trading which if I ever have a problem, I can pass the loss over to another part of the bank. And if I make lots of profits, well, I suppose I can keep a lot of it for myself, or at least give myself a nice big bonus. So that was the casino type effect. And it is, as I mentioned earlier, a zero-sum game. So there's nothing productive going on here. Lots of people making lots of money, but there must be an equal amount of people losing exactly the same amount of money. So it's not something that one would particularly encourage people to go into, especially if they don't know what they're doing, or even if they do know what they're doing. If you go back to Nick Leeson, the original rogue trader, he lost £827 million on Nikkei index futures for Barings Bank, brought down the whole bank. So that was the end of Barings Bank, just because of a rogue trader in derivatives, in derivative markets. Toshidi Aguchi, he lost $1.1 million trading in US Treasury bonds for Daewoo Bank. Yasui Hamanaka, he lost £2.6 million on copper futures for the Sumitomo Corporation. Apologies for my pronunciations of these. John Rusnak, he lost $691 million on foreign exchange options for Allied Irish banks. Chen Julin, he lost $550 million on jet fuel futures for China Aviation. So he wasn't a popular lad in China after that. Jerome Kerville, he lost 4.9 billion euros in European stock index futures for Societe Generale. And Kweku Adeboli, he lost £2.3 billion on S&P Standard & Poor's 500, the DAX, and the Euro Stoxx index futures. So there are great big examples of very large amounts of money that have been lost in derivatives markets through speculation and what one might describe as gambling. There is, of course, the wonderful example, which I did mention in the last lecture, but so good I'll have to mention it again, in the long-term capital markets, LTCM. They used a hedging model. In fact, Myron Scholes and Robert Merton developed this new method to determine the value of derivatives to protect against the potential for losses in derivatives markets. They won a Nobel Prize in 1997 as a result of it, and they were also directors of LTCM the year after, when it lost $4.6 billion and liquidated using that particular scheme. Now, why does it happen? Why do people, how are people allowed to lose these sums of money in these markets? So why do they do it? Well, they can, because they can do it. No one's stopping them. The products are very complex. People don't understand them at all. If you look at the Rogue Trader film, you'll see a clear idea of that. Nick Leeson was losing money in Singapore, and no one could, well, they could understand he was losing money, but they couldn't understand why and what was going wrong, and it allowed him to continue losing money for considerable amount of time, because all you've got to do is make the bet a bit bigger. If you lose just a little bit of money, you can double the bet, and if you win, you've covered everything. And if you lose again, well, you can double it again, and bets get bigger and bigger to try and make up for previous losses, but if you don't know what you're doing, it doesn't work out particularly well. And the casino side of this creates a different type of speculator's paradise. I described this before in a previous lecture with regard to fixed exchange rates. Fixed exchange rates are a speculator's paradise because if they're likely to be adjusted in value, you know which way the exchange rate is going to go. It's either going to revalue or devalue. Because you know which way it's going to go, you can buy that currency or sell that currency and make money. Can't lose, because if it doesn't go that way, it will stay where it was. So you can't lose. That's what a speculator's paradise is. This is a different type of speculator's paradise, because you create a situation where it's possible to, if you make money, it's recorded for you as a win. If you lose money, you can pass on the loss to somebody else. That's quite a nice situation in proprietary trading, and it is something which, running up to the global financial crisis and around that time, with large conglomerates where the proprietary trading, if they made lots of money for the bank, they'd have nice Christmas bonuses. If they lost lots of money, then it would be transferred the loss to another part of the bank where profits were currently being made. So you can create for speculators another sort of paradise in these markets. Now, it's a very interesting area, and you can go into a lot more complications than all I have suggested. Remember, all I'm trying to do is get you into your head the idea of what a derivative is. So it's something that has a value for a period of time based upon an underlying asset, but because it has a value for a period of time, that value changes over that period of time. There's a secondary market that develops to buy and sell these derivatives, or our secondary market is our derivatives market. Now, a suggestion for you, because we're coming up to Christmas, well, when you're watching this, it may not be Christmas, but there'll always be another Christmas ahead, or a birthday. And if you want to read about it, there's some really interesting books out there which explain a little bit about why all of this is interesting, fun, problems, big problems, so much a problem that you could bring down the world economy if you didn't know what you were doing. The Devil's Derivatives by Nicholas Dunbar is a great read. Why Aren't They Shouting by Kevin Rogers. You'd expect that if things are going wrong, then there'd be lots of people shouting out why, wouldn't you? When Genius Failed by Roger Lowenstein. The Misbehaviour of Markets by Mandelbrot. John Kay wrote a good book on other people's money, which is always much easier to do things if it's not your money, isn't it? And Meltdown by Thomas E. Woods explains a little bit about what happened in the run-up to the global financial crisis, and indeed what will happen in the run-up to the next crisis, or almost any financial crisis that's out there. So some books for you to read to sort of build on your knowledge here. And if reading isn't your thing, but Christmas is here and we're going to sit down and watch a few films, and there's some great films about these particular problems in derivatives markets. There is the original film of The Rogue Trader with Nick Leeson. That's always worth a look. One of the best ones is The Big Short, really a good explanation of what was happening in the run-up to the global financial crisis. And Margin Call, similarly. Enron, the smartest guys in the room, is a worthwhile watch, as is Inside Job. So some films for you if you don't want to read the book. So what I will do in the next lecture and the one after that is to try and look at the financial environment within which all of these things I've described so far are happening. I'm going to look at central banks next time and consider the extent to which they are culpable for many of the things that have happened, particularly looking at two big problems caused by the Federal Reserve, a couple of big problems caused by the Bank of England, and lots of little problems caused all the time by the way that central banks act. And then I'll try and take you back through really a whole sequence of events that have occurred because of people's knowledge or lack of knowledge about financial markets. So I hope you've enjoyed that one, and we'll leave you to start watching some films and reading some books about that. Oh, I suppose one other thing I should say, we are getting to a point in time where there are lots of things I've talked about which you think that's quite an interesting point, if there's any, of course. There will be something on my blog about interest rates, about derivatives, about what central banks do that are wrong, and mistakes in managing money, etc. So do by all means nip over to the blog if you want to read a few fairly short articles, again designed for people who have not much knowledge of the topic but are inquiring and interested in what's going on here. So thank you for listening, and I'll be back with the next lecture soon.